Wall Street just delivered a surprise start to 2026. And traders are split. Is this real strength or a carefully staged setup? Markets open the year not with panic, but with quiet confidence. Indexes are green, volatility is contained, and dips are getting bought faster than expected. But here's the key question every desk is asking this morning. Big money is already moving before retail notices. This isn't a market driven by hype. It's being driven by positioning. Institutional traders aren't reacting to news. They're reacting to liquidity, flows, and expectations. Early 2026, trading shows 3 important signals. No panic selling, selective buying, rotation, not risk off. That tells us something critical. When markets don't fall on bad news, someone is absorbing supply. Major US indices are showing controlled momentum, not emotional spikes. Pullbacks are shallow. Volume increases on up moves. Sellers are hesitant. This is not euphoria. This is measured accumulation. Traders are not chasing everything. They're choosing where to be exposed. And this is where the real story of 2026 begins. Because while the overall market looks calm, one sector is sending a loud message. One sector is seeing early inflows, higher relative strength, institutional footprints, and defensive growth characteristics. This sector isn't reacting to headlines. It's positioning for the year ahead. This sector isn't trading today. It's trading the next 12 months. Large funds don't wait for confirmation from the news. They move when valuations reset, liquidity improves, risk is asymmetric. Retail traders look for certainty. Institutions look for mispricing. That's why. Volume spikes before news. Charts break before narratives. And trends start quietly. By the time it's obvious, the move is already crowded. The macro environment heading into 2026 is mixed, and that's important. We have slower global growth signals, persistent geopolitical uncertainty, strong dollar pressure, and tight financial conditions. Yet the US market is not breaking. This is not a buy everything market. And it's not a sell the rally market either. This is a selection market. Stock picking matters, sector choice matters, timing matters. And the traders winning early 2026 are doing one thing well. They are following money, not emotions. Price doesn't move because of opinions. It moves because of orders. So let's answer the big question. Is this strength real or is this a setup? The answer right now is simple. It's real as long as money keeps rotating, not exiting. The moment flows turn defensive, the story changes. Until then, this market is not afraid. It's calculating. Stay with me, because one sector today is telling the real story of 2026. And if you understand why that sector is leading, you'll understand where Wall Street is heading next. Don't watch the headlines. Watch the money. This isn't noise. This is positioning. And positioning always speaks before price explodes. Let's start with the heartbeat of Wall Street, the major indices, because this is where market emotion meets real money. First up, the Dow Jones Industrial Average. The Dow is showing measured movement, not explosive action. This index is being driven by rotation, not speculation. Investors are shifting money out of crowded trades into stable cash flow names, favoring balance sheets over stories. This tells us something important. When the Dow moves slowly, institutions are choosing, not chasing. The Dow reflects how real economy stocks are being treated: industrials, financials, healthcare. No fear here, just careful allocation. Now let's widen the lens to the S&P 500. The S&P is not moving as a group. This is not a broad-based rally. Some stocks are moving sharply higher. Others are being ignored completely. This market is rewarding precision, not participation. That means index strength doesn't mean every stock is strong. Sector choice matters more than ever. Stock picking is back in focus. This is a trader's market, not a passive one. And now the Nasdaq composite. This index is doing the heavy lifting, driven by mega cap tech, AI-linked names, cloud, chips, and data infrastructure. But this move isn't emotional. This is not hype buying, this is capital commitment. Money is flowing into companies with strong earnings visibility, AI monetization paths, pricing power. The Nasdaq strength is targeted, not reckless. So why is the market behaving this way today? Let's break it down clearly. Federal Reserve expectations. Traders are positioning around future rate cuts, not today's rates. The market is asking, when will the Fed ease? How fast will financial conditions loosen? Even expectations can move prices. Markets don't wait for rate cuts, they trade the possibility. Big data is coming. In January, jobs and inflation data ahead. That means traders reduce risky bets, institutions hedge.
Right now, sentiment is selective, not broad. This market is not moving together. It's moving by intention. Some stocks are attracting money quickly. Others are being completely ignored. That's the first clue. Let's separate what's happening on the tape. Traders are reacting to headlines, to intraday price swings, to technical levels. Their focus is short-term. They care about today's move, this week's volatility, quick momentum shifts. Traders chase movement, investors chase meaning. Investors, on the other hand, are positioning. They're thinking, where will earnings grow this year? Which sectors survive higher rates longer? Who has pricing power in 2026? Their focus is long-term. This difference explains today's market behavior. At first glance, the market looks mixed. Some charts look bullish. Some look tired. Some look completely directionless. That's not confusion, that's selection. When markets stop moving together, leadership is changing. This is what happens when easy money disappears, risk gets priced properly, and capital becomes selective. The market isn't emotional, it's discriminating. Here's a fact most retail traders don't like hearing. Historically, early January moves often fake out retail traders. Why? Because institutions adjust portfolios quietly. Liquidity is still thin. News flow feels bigger than it really is. January shows direction, but not confirmation. Early moves create false confidence. Retail traders see a green open, a strong first week, a trending chart, and assume the year is decided. Professional money doesn't think that way. Smart money uses early January to test liquidity, observe reactions, build partial positions, not full commitment, not emotional bets. They wait for economic data, earnings guidance, policy clarity. Big money watches reactions, not predictions. There's no panic. There's no euphoria. That's important. Markets usually peak with excitement. They bottom with fear. Right now, neither. This tells us risk is being managed, volatility is controlled. Moves are intentional if you're trading. Respect levels, reduce position size, avoid chasing if you're investing. Watch leadership, track relative strength, be patient. This is not a market that rewards impatience. The market isn't here to entertain, it's here to transfer money. So let's summarize sentiment right now. Selective, not broad. Rotational, not emotional. Strategic, not speculative. And most importantly, early January is information, not confirmation. Now, let's talk about where the money is actually moving sector momentum. This is the phase of the show where opinions stop and price action starts speaking. Two sectors are standing out today, not because of headlines, but because of consistent buying pressure. Let's start with technology. This sector isn't just strong, it's leading. Key names on screen: Apple, Microsoft, Nvidia, Alphabet. These are not speculative trades. These are institutional core holdings. Leadership stocks don't spike, they grind higher. The reason is simple. AI spending is real, and it's showing up in corporate budgets. Cloud infrastructure demand, enterprise software contracts, these companies have. Strong earnings visibility, cash-rich balance sheets, global pricing power. Even in uncertain macro conditions, capital wants predictability. Money flows to certainty when uncertainty rises. This is why dips in mega-cap tech are getting bought quickly, not chased, absorbed. Now let's talk about energy. This sector is moving for a very different reason. Key names on screen: ExxonMobil, Chevron, Occidental Petroleum. Energy momentum is being driven by risk, not growth. When geopolitics heats up, energy charts move first. Oil markets hate uncertainty. Right now, traders are pricing in geopolitical risk, supply disruption fears, shipping and insurance costs, OPEC supply discipline. Even small disruptions can have outsized price impact. Energy rallies don't need confirmation, they need fear. Energy stocks benefit from higher crude prices, strong free cash flow, share buybacks, and dividends. This makes them attractive in volatile environments. At first glance, these two sectors look unrelated. One is about future growth, the other is about present risk. But they share something important. Momentum isn't random, it follows purpose. Both sectors offer clear earnings visibility, strong balance sheets, institutional confidence. Money is not chasing hype. It's positioning for scenarios. If you're trading, follow relative strength, avoid lagging sectors. Don't fight leadership. If you're investing, watch which leaders hold gains. Track volume on pullbacks. Let the market show you conviction. This is how early year trends begin. Strong sectors lead quietly, weak sectors fail loudly. Technology is leading on growth, clarity. Energy is leading on global risk. Different reasons. Same result. Money is moving with intention. Let's shift from sectors to stocks, because this is where momentum becomes visible. These are the names pulling attention right now, not because they're trending online, but because money is actively flowing into them. These stocks are moving on real demand, not social media hype. Let's start with Nvidia. Nvidia continues to act like the backbone of the AI economy. This is not speculative buying. This is infrastructure demand. Why Nvidia has momentum. Nvidia benefits from exploding demand for AI data centers, long-term contracts with hyperscalers, visibility that stretches quarters, not weeks. Every major AI build-out still runs through Nvidia. Infrastructure stocks don't spike once they trend. Notice on the chart. Higher lows, strong volume on up moves, buyers stepping in quickly on dips. That's institutional behavior. Next up, AMD. AMD is moving on a different AI angle. This is about server CPUs, competitive positioning, share gains in data centers. Investors are pricing in rising enterprise demand, increased adoption in cloud workloads, long-term margin expansion. AMD doesn't need to dominate. It just needs to take share. When second place demand rises, valuations follow. The chart reflects belief, not excitement. Now let's look at Meta. This is one of the most misunderstood momentum stories. Meta's move is not about metaverse headlines anymore. Meta is being rewarded for AI-driven ad targeting, cost discipline, improved margins, strong cash generation. AI here is not futuristic, it's operational. Efficiency is the most underrated growth story. Meta's chart shows smooth trend structure, healthy pullbacks, buyers defending key levels. That's conviction, not speculation. Now to Palantir. This stock is moving on contract visibility, not hope. PLTR benefits from government contracts, defense and intelligence spending, data analytics demand, long-term institutional relationships. In uncertain geopolitical times, governments spend on data. When uncertainty rises, analytics becomes essential. PLTR's price action shows fast reactions to volume, breakouts holding, momentum sustained beyond headlines. That's real demand. Different businesses, different industries, but one common thread. Momentum is following earnings visibility. All four stocks offer clear demand drivers, strong institutional interest, forward-looking revenue confidence. This is not gambling. This is positioning. Momentum stocks are powerful but not forgiving. Chasing late can be costly. Smart traders watch pullbacks, respect risk, follow volume. Smart investors focus on structure, track earnings, ignore short-term noise. Momentum rewards discipline, not emotion. NVIDIA, AI, infrastructure. AMD, data center demand. Meta.ai efficiency and ads. PLTR, government and defense analytics. These moves are not accidental. They are demand-driven. They are visible on the tape. And they are shaping early 2026 leadership. Politics doesn't move markets daily, policy does. And right now, markets are listening closely not to campaign speeches, but to signals coming from Washington and the Federal Reserve. Let's start with the Federal Reserve. There's been no dramatic policy change. No emergency move. No surprise announcement. But the tone has shifted. Markets don't trade decisions, they trade direction. Recent Fed commentary suggests a more balanced view on inflation, increased attention to economic data, less urgency to remain aggressively restrictive. That doesn't mean rate cuts are guaranteed, it means the path is being discussed. Rate expectations are doing more work than actual rates. Traders are positioning around when cuts might begin, how many could happen, and how fast conditions might ease. This impacts equity valuations, bank margins, housing activity, currency strength. Expectation moves markets before action ever does. That's why even small changes in language can shift billions of dollars. Now let's talk politics, but through a market lens. Investors aren't reacting to debates. They're watching fiscal discipline. The key questions. Will spending remain controlled? Will deficits widen further? Will policy support growth without reigniting inflation? Markets reward discipline, not drama. Any signal of excessive spending, policy uncertainty, or budget instability can quickly affect bond yields, dollar strength, equity risk premiums. Markets are sensitive because valuations are forward-looking, debt levels are elevated, rate policy is near a turning point. This creates a narrow path. Policy missteps matter more when margins for error are smaller. When policy risk rises, selectivity increases. Traders react quickly to headlines. Hedge around Fed events. Focus on short-term volatility. Investors watch consistent. Track policy follow-through. Focus on earnings impact. This is why markets may look calm while positioning underneath is active. Fed speeches and meeting minutes. Inflation and employment, data budget negotiations, and fiscal updates. These will decide whether confidence builds or caution returns. Markets don't fear politics. They fear unpredictable policy. The Fed is watching data. Markets are watching tone dot. Investors are watching discipline. No panic, no euphoria. Just a market trying to understand the next policy step. Now, let's widen the lens because Wall Street never trades in isolation. Geopolitics doesn't just affect foreign markets. It enters us markets through energy prices, supply chains, currencies, and earnings. And right now, global pressure points are clearly visible. Global news always hits us markets first. Let's begin with the Middle East. Any increase in tension around key oil-producing regions immediately impacts crude oil futures, shipping routes, energy insurance costs. Markets don't wait for disruptions. They price risk. Energy stocks respond because oil supply is globally interconnected, spare capacity is limited. Even small disruptions shift pricing power. As a result, oil prices move, energy equities follow, inflation expectations adjust. Oil doesn't trade on headlines, it trades on fear. This is why energy stocks often rally before any real supply impact is confirmed. They are a hedge against uncertainty. Now to the most sensitive trade relationship in the world, the United States and China. This relationship matters because it sits at the heart of semiconductor manufacturing, advanced technology, AI development. Chip stocks react to policy talk faster than policy action. Semiconductors depend on global supply chains, export licenses, cross-border capital investment, any signal of Trade restrictions, tariffs, technology controls can instantly affect revenue forecasts, capital spending, valuations. That's why semiconductor stocks often show volatility before the policy details are finalized. Markets price possibility, not certainty. Now, let's talk about the strongest invisible force in global trade, the US dollar. A strong dollar has consequences. When the dollar rises, US exports become more expensive overseas. Foreign buyers reduce orders. Overseas revenue converts back at lower values. A strong dollar helps importers but pressures exporters. This impacts multinational earnings, manufacturing competitiveness, global sales growth. Even companies with strong demand can face currency headwinds. Smart money watches trade flows closely because import-export data reveals future earnings trends, supply chain health, economic momentum. Ports and shipping data often speak before earnings reports. Changes in shipping volume, freight costs, and export orders often appear months before they show up in financial statements. Put it all together. Middle East risk energy volatility. US-China tension semiconductor sensitivity. Strong dollar export pressure. These forces don't operate separately. They combine to influence inflation, interest rates, corporate margins, investor positioning. Global risk doesn't knock, it shows up in prices. Geopolitics isn't background noise. It's a leading indicator. Energy prices, chip stocks, and the dollar are telling us how global risk is being priced today. And Wall Street is listening carefully.
As we head into the next phase of the market, the question isn't what just happened. It's what comes next. Because markets don't move on the present. They move on what's about to be revealed. Let's start with the jobs report. This is one of the most important data points for markets right now. Why? Because employment sits at the center of consumer spending, inflation pressure, Federal Reserve policy. Jobs data doesn't just move markets, it reshapes expectations. Traders will be watching payroll growth, wage inflation, labor participation. A strong report can delay rate cuts, lift the dollar, pressure rate-sensitive stocks. A softer report can support easing expectations, help equities, reduce bond yields. Next up, inflation data. This remains the single most important macro driver. One data point can change the rate narrative. Markets want confirmation that inflation is cooling sustainably, not reaccelerating, aligned with the Fed's target path. Even small surprises can reprice bonds, shift sector leadership, change equity risk appetite. Fed speeches are next, not because of what's announced, but because of how it's framed. Markets will listen for confidence or caution in tone, references to data dependence, subtle shifts in wording. Tone changes move expectations. Expectations move markets. And now, the most concrete catalyst, earnings season. This is where narratives meet numbers. Earnings don't care about opinions. Investors will focus on forward guidance, margin trends, demand visibility. Early reporters often set the tone for entire sectors. Strong guidance can lift peers. Weak outlooks can pressure entire industries. With this much data ahead, discipline matters. That brings us to today's trader tip. Watch reaction, not prediction.